Hello and welcome back to my fourth episode on my weekly forecasting series where we go through the Forex markets, mainly covering the dollar index to give us some sort of idea on directional bias for the up and coming week. So I basically just run through all the things that you guys might need to know that will be up and coming. So this might be a bit of a shorter commentary just purely because of the absolute chop that the dollar index has been within. So if you've been watching my last couple of videos, you know that we've been favouring a lower dollar. As you can see, I have marked out these weekly targets on the sell side delivery that I think I pointed to last week as future draws. And I still have these future draws as targets. However, we are quite, just sat range bound. If I go on the daily chart from the weekly, nothing much has changed, to be honest. There's not much to talk about from a technical aspect. There's no PD arrays that are forming properly that we can key off of from RCT concepts. We have just been range bound, and I think this has been the chop of the year, really, mainly due to the fact of we have had the inflationary problems in America, also with the unemployment data that's been sort of contrasting higher and lower. And I've been forecasting that I think it'll just move down because rate cuts have become more and more predicted throughout the financial markets. However, now I wanted to sort of take a bit of a different stance on this. Next week we have the FOMC statement, which will decide on what the interest rate will be moving forward, and they'll shed a bit more light on what they want to do with it for the up and coming months. And I basically just think now the market is waiting for this. Usually I would have thought that it would have been priced in with the data. The unemployment data has been pretty bad. Inflation has been as expected, which is still pretty high. However, you have to think about it in a way of, if you get what is expected from inflation data and the other problem is unemployment, and that's actually coming out consistently worse than expected, then traders and hedge funds will look to position for repricing that data in, especially if it's much worse than expected, which is what we've seen in unemployment. So for the actual dollar, the main thing I would be focusing on is capital preservation. I would just be looking to hold as much capital as I can. I wouldn't be looking to trade any of this, because if you try and position in this daily chart, you will just have chop and less favourable trades that won't be running your way. So if you can see, it's just going up and up and down. And once you drop down to the lower time frames, if you trade intraday, these will just be very harsh reversals against you. There will be no trending format. So if we drop down to a 15-minute chart, look at all this. Look at all these positions that if you were in, how quickly it goes the other way. And this is this is where most traders just absolutely burn themselves. There's just high probabilities of just getting caught in chop and it getting blasted to your stop loss. So I don't really fancy anything within this. I will just wait for the sentiment to build, wait for the fund rate to drop now, which is next Wednesday, and see from there if we get any sort of trending markets. I am still currently positioned in my USDCHF trade, as I'll bring up here. We had quite a nice expansion from NFP. We come up to this daily fair value gap. If I just mark this out here, I'll delete this fib actually just so it's a bit clearer. We come up, hit this daily fair value gap, and we have then respected that. As of now, we had a previous day high sweep over here and a close lower, which is pretty nice. However, with the DXY chopping, you have to take some sort of stance on the fact that if this is chopping quite badly, then this isn't likely to run. You usually want nice clean sweeps with the DXY holding the exact same nice deep sweeps, as these will give you clear and defined swing points to put your stop loss. I always see my stop losses, right, if price gets here, I don't want to be in the trade anyway, and I can't really predict anything lower down on why, where I would safely position a stop, because if you could, for example, place a trade on a swing like this, but if the dollar starts chopping, then this can easily go, even though it looks pretty nice from a technical standpoint, which is why I'd just stay out for now. As I was positioned up here, My stop loss is this line here now, break even. I'm just covering the swaps on the trade. We are currently, let's have a quick look at this. We're currently just over nearly 4 are up on this trade, which is obviously very nice. However, I do believe that the FOMC statement will prevail and go my predicted way, which is lower, so I have no reason to cut this trade. You know, you've really got to make sure those winners are winning, and I'm comfortable enough to hold this trade. So, one thing I did want to cover, if you have a look at the dollar index, it's pretty choppy at the minute, and it doesn't give you much telltale signs to where it's going if you were just looking at it from a technical perspective. Now, if we have a look towards the US bond market yield, the US 10-year yield, we can see that there's actually been quite significant dumps in recent times on the daily chart, and then the US 30 is the same. We had a really harsh dump actually from where we were, and this is a good indicator really. It's like it's allowing you to see where the money flow is, and you do know they are, you know, positively correlated, which means that if the DXY is chopping, however the bond market is moving lower, especially before a big news driver such as the rates, then you can sort of get again another confluence with your bias that we should be looking to trade lower on the dollar, which is why I'm interested in this. So if we have a look at EURUSD, it's the exact same thing. We've just been chopping around. You know, it's holding up quite strong, the euro is, which is good, similar to USDCHF is holding up lower. GBPUSD, again, a similar thing. We've started to move higher now. However, I'm still waiting for the DXY to tell me, you know, this is my measuring stick. If this is within a chop, I won't look to other things to try and position. I will just wait for this to become clear, and then as soon as this is clear, I will look to position in other markets. Now, this is the main thing really. You know, trading months aren't always going to be the same. You're not always going to make a consistent percentage within the market month on month. Your P&L will always be built in a couple of good trades throughout the year. Couple of good months, you'll get a good positioning, good opportunity, a nice trend that you can follow. And I believe that this is where most traders go wrong. They are always trying to position at every time within the year, and some months just aren't as favourable as others. For example, if we have a look at the dollar index at the start of the year, you know, with the tariff announcements, we had a clear trend lower. And then if you're trying to position yourself within the same amount of trades within here, there just isn't the expansion to get the good risk on rewards. So that's a pretty, you know, easy sign to, you know, look back at data and say, right, if I was positioning short within this area of the market and I was positioning short or long within this area of the market, which do you think is going to have the better return? It's not worth the headache. It's not worth the stress. You know, trading's one of them games where you get paid for your accuracy, not your time. So it's really, really important to remember that you're not going to always find the same amount of P&L throughout the year. It's just about maintaining the capital in the less favourable times. So if we look towards the CME report, which is something we've been looking at over the past couple of weeks, we still have a high probability. Well, it's currently priced, you know, this sentiment chart is 100% on a rate cut. We're currently at 4.5, and this is a 25 to 50 basis points rate cut, and this is a 50 basis point rate cut, and this is pretty damning to show that, yep, traders are believing a rate cut is coming, and obviously we just need to wait for that to be priced in. So if we look to the Forex factory calendar and we go to the week that is just gone, we can see that there wasn't much early week. PPI come out negative actually, which was, you know, inflationary's down. And then the Thursday was where the main data was. We had more unemployment than expected, which is obviously more negative for an economy, which is a confluence for a lower dollar. And then we had the CPI month on month come out just a little bit higher. However, the year on year was the main one, and it come out as expected. Again, the data's done. Inflation is where they thought it was going to be, which is still quite high, but there was no super sort of unexpected change in the data, and the unemployment was actually higher than expected. So we can then look on to next week. Let's go through this. Monday, there is nothing. Tuesday there is core retail sales. However, the Wednesday does hold the FOMC statement at 7. So with such a large news driver in the market, and with the fact that we've been in a heavily consolidated chop anyway, I would definitely just forget about early week as trading. I would wait for this Wednesday to pass, wait for the statement. You know, if you can let 3 days go and that gives you a couple of weeks of bias, then I personally think that is a good trade-off that we should all be willing to make within the markets. You know, I don't need to make anything P&L wise on the Monday, Tuesday or the Wednesday. I'd rather just wait for this statement to come out, and then we'll have a clear sort of outlook on direction that we can then review next week. We have unemployment claims the day after, and on the Friday we have pretty much nothing for USD news. So that's pretty much it, really. We need to wait from my position, I want to wait for the FOMC statement, see if that goes in the way of a rate cut, which I've predicted for many weeks now, and then from there, see if we can get some sort of out of this consolidation and see if the trend can prevail, you know, give us some sort of clues on direction. You know, you've got to remember all the key concepts of ICT that I follow personally: weekly profiling, displacement, PD arrays on a higher time frame. They're all out the window on a consolidation. It's very important to remember that reversals are happening, you know, start, mid and end of the week, which just isn't helpful for gauging direction and having a bias where you can clearly trade. So especially if you're an intraday trader, it's even worse. You know, don't try and position within this, and you will save the capital to trade, because, you know, good times and good opportunity does always come back in the market, and that's our job to be there when that does happen. So again, not really a technical video. You know, since I started this series, we haven't had too much to talk about in terms of technicals, actually, because we've just been in this chop. I mean, I think I started this 4 weeks ago now, which was around this time here in the market. So we've just had this, which there isn't much to commentate on other than the technical aspect. We've covered the bonds. I think I might be doing a couple more in-depth videos just talking through how I build a bias and how I can sort of predict where the market might go for my own confluences. So I'll have a see if those are out midweek. But other than that, thank you very much for watching, guys, and have a safe week's trading.